To take you live to House Republicans talking about financial regulations, one of several events today marking 1 year since the government stepped in to shore up financial markets. You see Spencer Bachus, the Financial Services Committee ranking member, on your screen. He'll be joined by other GOP committee leaders. Live coverage.
The past 2 years is that we need smarter regulation, not that we need more regulation, that we need the government agencies that are assigned to assure safety and soundness and consumer protection do their job, not the creation of more government agencies, of consolidation, not more agencies. We became the greatest economy in the world through hard work, innovation, individual choice, and allowing people to succeed and to fail. We don't want to give that up. Unfortunately, that's a lesson that is lost on the administration as it pursues an overly ambitious economic agenda. As in the case of health care and energy policy, the President has offered a reform proposal that would grant broad new authorities to government bureaucrats, create new government agencies and bureaus, while unduly intruding into the private markets, innovation, and restricting personal choice. We need an approach to regulatory reform that draws on the strengths of our economy and our present system. We need to end the bailouts once and for all, get the government out of picking winners and losers in the market, and restore market discipline so that financial firms will no longer expect the government, or more correctly, the taxpayers, to rescue them from their consequences of their imprudent business decisions or guarantee their obligations. Those are the principles on which the Republican regulatory bill is based. In addition, a number of us have introduced legislation this week to create an independent trust to divest the government's ownership interest in companies such as AIG, General Motors, Citigroup, and Chrysler. To expand on the points I've outlined, I'm pleased to be joined by a number of my esteemed colleagues on the Financial Services Committee. At this time, I want to call on a member of our committee, but also the ranking member of the Agricultural Committee, Frank Lucas, for his remarks.
Thank you, Ranking Member Bachus, and it's been a pleasure to serve with you on Financial Services Committee, as well as in my role as Ranking Member on the House Agriculture Committee. At a time when America is becoming more cost-conscious, and literally that means the business of America also, dealing with the financial challenges they face, this proposal from the administration, with its goals of higher margin requirements and with all of its other capital requirements, seems to place a potential for a dramatically greater cost on using the financial derivatives in order to spread their risk, in order to meet their needs in the coming months and days and years. That, I think, is probably one of the greatest errors in this proposal. At a time when we face these challenges, when business has legitimate needs for these kind of tools, we set potentially a standard by which regulators, through their ability to manipulate the margin calls, the capital requirements, potentially could drive these instruments right out of existence. We on the Ag Committee have worked very hard, and also in my role in financial services, to try to create a balance, to understand that the derivatives and the over-the-counter markets represent a very fundamentally important financial tool for a number of industries. Were there problems and challenges? Yes. Is the basic principle behind these products sound? Yes. Can we do more things to rationally provide oversight? Absolutely. But the direction the administration appears to be headed, I think, deviates away from that and takes us in a destructive direction that will provide fewer choices, fewer options for our business, and thereby increasing their risk and their exposure. With that, I'd like to turn to one of my colleagues from the Financial Services Committee, one of the ranking subcommittee members, the gentlelady from Illinois, for some observations she has, Congresswoman Judy Biggert.
Thank you, Mr. Lucas. I guess you're the twofer for this press conference. It's not very often that that happens, but thanks for all your comments. You know, what's the answer to the financial meltdown? How do we prevent it from happening again? What is not the answer is the Democrats' plan to create another federal agency, allegedly to protect consumers. We already have the OCC, the OTS, the NCUA, the FDIC, and the Fed. So why not address the real problems with these agencies instead of creating another one? Are we creating another agency or just another problem? One lesson that we learned is that bigger, uncoordinated government does not work when it comes to protecting consumers and regulating financial institutions. Instead, it only creates more cracks, confusion, and costs for the consumer. And what's the cost of the new bureaucracy? The new agency has the authority to level fees on consumers and businesses, which amount to more indirect taxes. Most of these folks didn't create the financial crisis. Did Walmart and our local 100-year-old community banks, churches, or your plumber who gives you a payment plan create the mess? No, but all could find themselves regulated and taxed by this new agency. Another victim of this new bureaucracy is consumer choice. The agency can tell businesses what service products that they can offer certain consumers, and it can make financial decisions for American families, which really is an insult to the majority of Americans who act responsibly with their finances. With the right information, proper transparency, and full disclosures, families can and do make their own financial decisions. They don't need Big Brother to do it for them. Instead, Congress and this administration need to go back to the drawing board, make tough choices, and empower consumers with stronger, smarter financial regulations. Consumers should be the top priority of banking regulators, who should also monitor the safety and soundness of financial institutions and not issue conflicting regulatory mandates. That's what our GOP plan does. It also protects consumers against fraud and gives consumers the tools to make the informed decisions or file complaints against fraudsters and scam artists. We don't need a Band-Aid consumer financial agency that is a facade for reform. We do need to end bailouts and the government practices of picking winners and losers and restore market discipline. We need reform. We need smart, clear, and strong regulations to get our financial system back on track so that our economy can grow businesses and can create desperately needed jobs, and American families can secure credit. Now I'd like to introduce Representative Shelley Moore Capito, the ranking member on the Housing Subcommittee and the Financial Services.
Thank you, Judy, and thank you all for being here today. What we're talking about, of course, is our ideas on regulatory reform. My segment of the presentation will be, what about when these big firms are on the verge of collapse? What is your idea? Well, I think one thing we know is that the bailout of failed firms that has become almost second nature is not the direction that we want to go. We've seen our government reward poor decision-making, absorb enormous losses, and then stick taxpayers with the bill. With our constituents facing severe bailout fatigue, regulatory reform will finally put an end to this mentality of the government picking winners and losers. Yet the President's financial regulatory reform, I think, will actually institutionalize this concept, only guaranteeing more bailouts in the future. What we believe that failed firms must face the consequences of their decisions. We've called for a new chapter of the bankruptcy code that would be more suitable for unwinding failed firms. Moreover, the certainty provided by a firm commitment to the no more bailouts will force banks and financial entities to account for their decisions. With a new chapter of the bankruptcy code, we can bring technical and specialized expertise to the table to help unwind these firms. Special classes already exist in bankruptcy for farmers, municipalities, and railroads. Most importantly, there will be no more question of waiting for another government bailout. It's a time for certainty in the marketplace because taxpayers shouldn't be on the hook for the decisions that are made in Wall Street or elsewhere. And our next speaker is Jeb Henterling from Texas.
It was almost 1 year ago that the Emergency Economic Stabilization Act that created TARP was passed into law. We're not here to debate the impact of that legislation 1 year ago. We are here to debate what that legislation means today. Legislation which was designed to be emergency legislation to deal with financial stability under this administration has now become a $700 billion revolving bailout fund to advance the political, social, and economic agenda of the administration. The administration and the previous administration crossed a line when they first gave funds to GM and Chrysler. If they are defined as financial institutions, what Fortune 500 company is not defined as a financial institution? We now have a test. If you can garner a headline, you can garner a bailout. That is where TARP is today. This administration crossed another line when they put forth a plan leveraging TARP funds that gave a sweetheart deal to their political allies in the United Auto Workers at the expense of investors, including farmers, ranchers, and pipe fitters in the 5th Congressional District of Texas, who invested tens of thousands in GM bonds for their 401k. They ended up with pennies on the dollar, and the UAW ends up owning Chrysler and getting a better deal than senior secured creditors and those who were equal to them under our bankruptcy code. Now, all of a sudden, investors have to calculate political risk in the United States of America as they do in third world countries, fearful that their property can be confiscated. Republicans want to use the voluntary capital of investors to grow our economy, not the involuntary capital of taxpayers, which is part of the TARP program. Fiat ended up with 20% of Chrysler, up to 35%, not being owed one dime, not having invested one dime, if they will produce green cars in the years to come. Now, we know the President is serious about his global warming agenda, but what Fiat and producing green cars has to do with financial stability is beyond me and is beyond those who are behind me. Already we know that there's $700 billion allocated to the TARP program. The CBO, Congressional Budget Office, has estimated that the taxpayer will lose at least 50 cents on the dollar. The Democrats' capital markets reform legislation functionally ensures that we will have TARP for years to come. It will enshrine us as a bailout nation. It will cost taxpayers billions of dollars. It will allow the picking of winners and losers. It will politicize our economy, and that's why we need the Republican alternative that ends us as a bailout nation and makes sure that risk is lessened by market competition and not incompetent market fiat. Next, I am proud to introduce the vice-ranking member of the Financial Services Committee, the gentleman from Texas, Randy NEUGEBAUER.
Thank you, Jeb. You know, in the past year, we have seen unprecedented, if not historical, intervention by the federal government into our financial markets. Now it's time for government to start focusing on its exit strategy and stop bailing out more entities. We agree with President Obama that there is some reform needed in our system today, and that we need to learn some of the lessons from what has happened over the past years. But we also think our reform plan is a better plan for the taxpayers and much better for the economy. Our reform plan puts the taxpayers first and aims to ensure that there are no more bailouts. The President's plan puts the federal government in the permanent bailout business, and that's not good for the taxpayers or the American people. Identifying entities as specifically as systemically significant as the President's plan does puts the government back into picking winners and losers. It unlevels the playing field. The other thing that it does is it concentrates way too much power into the Federal Reserve. When you check the box for an entity to be systemically risky, you say to the rest of the world, this is an entity that we will not fail. And what you put the taxpayers on notice is get your checkbooks out, because eventually you're going to have to write a big check. Instead, our plan sets up a council, the Market Stability and Capital Adequacy Board, that will produce a real coordination between all of the regulators and require them to look across the financial entities, close the gaps, review the capital requirements, and make sure that these entities are holding a sufficient amount of capital. The current Federal Reserve Chairman and the previous two Federal Reserve Chairmen all say that a lot of the problems that we have today could have been avoided if these entities had been adequately capitalized. Instead, they were not being asked to put up the amount of capital required to take the risk that they were actually engaging in. The President talked about responsibility yesterday. The taxpayers want and deserve more accountability and responsibility from their regulators. Our plan says that financial regulators need to be more accountable and do a better job. We don't need more regulations. We need regulators doing a better job. Setting up the Fed as the too-big-to-fail regulator, giving some firms special status, does nothing to hold those individual functional regulators accountable. Rather than more bailouts and more bureaucracy, we need more regulator accountability and more taxpayer protection. And that's the reason that the Republican plan holds to the market principles, consolidates the regulatory process, but also sends a clear signal to the regulators: you need to do your job, and we do not need to set up a situation where the American taxpayers are being put at risk again to bail out people that make bad choices. And now it's my pleasure to introduce a gentleman from California, Mr. ROYCE.
Thank you, Randy. I'm Congressman Ed Royce from Orange County, California. If you were to ask economists what created this fiscal calamity, the first thing they would point to is the Federal Reserve and other central banks who, over a period of 4 years, set interest rates at a negative level, negative real interest rates. And so that created a great deal of ballooning in the economy, especially in the housing sector. Why so much in the housing sector? Well, for a couple of reasons. One, regulators and Congress allowed over-leveraging in that sector. But specifically, one of the things we did in Congress, and it's never comfortable for members of this institution to look back at the role they played, but one of the things we did in 1992 was to pass the GSE Act. And as a consequence of that legislation, we allowed government-sponsored enterprises to over-leverage at a ratio of 100 to 1, and specifically in exchange for the goals that we set in Congress, they were supposed to, in their portfolio, hold 1/2 of those assets in subprime and Alt-A loans. That's 1/2 of $1.5 or $1.6 trillion, leveraged 100 to 1. Now, the consequences of that, of course, eventually, was that first the Federal Reserve came to Congress and warned us in 2004 that we faced a systemic risk throughout the entire financial system, that there would be a collapse. And Congress decided not to take action, not in that year or any of the following years. As a matter of fact, I remember some of the debates on this, and I remember Barney Frank, who's now chairman of the committee, saying when it comes to regulating Fannie and Freddie for safety and soundness like we do banks and thrifts, I don't want to do that, because when it comes to affordable housing, I'm willing to roll the dice a little bit on risk for affordable housing. A decision was made by Congress to allow this type of over-leveraging, and the cost to the taxpayers could accrue to about $400 billion. The cost to the system in terms of housing, the losses, were over $1 trillion. So what I'm sharing with you is that it was government intervention in the economy. And subsequently, the thing that concerns me is that a lot of this debt, a lot of this over-leverage has been transferred now onto the government, onto the taxpayers going forward. And what we see is a compounding of that initiative, of continued government intervention into the economy. One of the other concerns I have here is exactly what led to the problem with Fannie Mae and Freddie Mac, and that is the inability of a regulator who gets trumped by, well, in this case, you had OFEO, but you had HUD, and HUD was in charge of the mission. So you had bifurcated regulation, the same type of thing we could end up with if we listen to the concerns of the current safety and soundness regulators who are opposed to this Consumer Financial Protection Agency. What they're worried about is dueling regulators who bifurcate that regulation and do what HUD did with respect to Fannie and Freddie, which is to say, no, we trump safety and soundness because we have this mission requirement. In this case, our mission requirement is to get subprime lending up in the United States. We have to have a portfolio of 50% subprime and Alt-A loans. Therefore, we're not going to look at safety and soundness. We're going to look at this mission because it trumps safety and soundness. So when we look at this CFPA, this new agency that's being advanced, and we look at why the regulators are concerned about it, the reason they're concerned in my mind, and listening to them, and we have an opportunity on Monday nights to go here as members of Congress and sit down with regulators and former regulators to try to, over dinner, figure out how we got into this mess. What I'm reporting to you is that their concern is that if we walk down this road, we're going to replay the problem, these types of problems that we saw with the government-sponsored enterprises. And given the massive losses that were created there, anytime you try to short-circuit the market and you believe in the fatal conceit that members of Congress can achieve a goal just by mandating that goal, or you give a regulator a power to trump safety and soundness, at the end of the day, you risk the type of meltdown that we saw in housing. And I just have to go back to those conversations in 2004. It turns out that the Federal Reserve were exactly right. What they warned about, the meltdown that would occur in housing if we did not heed their advice for Congress to step in and pass the regulatory ability for the regulator to intervene for systemic risk at that time. They said this would lead to a potential systemic risk to the entire financial system. I think it's very, very clear that we should back off of this approach and begin to listen to the good advice that's been given to us in the past by the regulators, and with respect to the Fed, the advice they gave us about systemic risk. Thank you very much.
We have one more speaker, Tom Price, is that right? And then we'll take questions.
Thank you, Spencer. My name is Tom Price. I represent the 6th District of Georgia, and I think you can tell the knowledge and the passion and the common sense that my colleagues on the Financial Services Committee bring forward on what is really a challenging issue. As a physician, I know that in order to effectively treat a problem, you got to make the right diagnosis. And in this effort, the Democrats and the President have failed. In fact, some might suggest that they are about to commit malpractice. Now, while they have indicted capitalism, it was instead the implicit promise that tax dollars would serve as the financial system as a backstop, which distorted our market system. It became an explicit promise shortly thereafter. This too-big-to-fail guarantee led to a recklessness at every stage of this bubble, from the very first bad loan all the way to the restructuring process. So at the heart of our solution, a positive solution, is the true separation of tax dollars and private risk. We must not continue to privatize reward and socialize risk. So our plan, our positive plan, creates a new legal process for the orderly winding down of insolvent firms so that they won't continue to burden taxpayers or impair the broader market. In short, as the sign says, no more bailouts. This new legal process will ensure that technical and specialized expertise is applied to these complex institutions, and all defunct non-bank financial firms would be subject to the same laws. Unfortunately, the resolution process in the President's plan will ensure more bailouts. His proposal would codify, would put into law the misguided policies that allowed the bailouts of AIG, Bear Stearns, and others. So while the President lectures the financial industry, it is in fact he who has not learned the lessons of the last year. And not until we stop enabling financial recklessness with a taxpayer lifeline will we see the financial system acting with the discipline and the responsibility that we all seek. Our proposal is a positive solution. I'm proud to stand with my colleagues on the Financial Services Committee who have put forward a solution that is based in fundamental economic principle and fundamental American principle. And I'm pleased to yield back to Spencer Bachus, our ranking member.
Thank you, Congressman Price, for those thoughtful remarks and for all our members. We're going to take questions at this time, and I'll refer those questions to different members. Or
I had a question about the Financial Crisis Inquiry Commission is going to meet for the first time on Thursday. I'm wondering if any of you have any thoughts about your expectations for this panel. And also, if you are aware of the new executive director, Thomas Green, has been named. He's an antitrust lawyer who's gone after such companies as Microsoft, Enron, and the tobacco industry. I don't know if any of you are familiar with him or would like to comment on that selection.
well, he's a Californian, and, which is Ed. I don't know if you, but we think that the proof will be in going forward. But we do feel like there was a need to obviously determine the causes of the financial crisis, the multiple causes, and yesterday there was a focus on that Lehman caused all this because we didn't bail out Lehman. Well, in fact, we bailed out Bear Stearns and a succession of companies prior to that, including IndyMac and, more importantly, Fannie and Freddie. There were several that were bailed out, and it obviously did not prevent a worsening crisis. I think there was no accident that the President chose Lehman, which was perhaps the only major financial corporation that wasn't bailed out. And I think that fits in with his message, but I think it's the wrong message. I wish he'd picked Fannie or Freddie or General Motors and talked about some of that.
Spencer, can I say a word about this? I serve on the Congressional Oversight Panel, which has looked into this issue. As far as the Historical Inquiry Panel or Commission, clearly we're disappointed that it's rigged in favor of the Democrats. If it was going to be a more serious effort in historical inquiry, I think it would be balanced. So I suppose we go in here with very high hopes and very low expectations. But I think the gentleman from California, Mr. Royce, did an excellent job of laying out, again, how the premise that says that somehow deregulation led us here is simply incorrect. It wasn't deregulation, it was dumb regulation. And with the exception of Congress resisting any regulation over their financial Frankensteins created in a government laboratory, Freddie and Fannie, you really can't point to any lack of regulatory authority that could have kept us from the economic crisis. You can say regulators were incompetent, you can say they were dumb, you can say they were simply mistaken, but you cannot say they lacked the authority, with the exception of Fannie and Freddie, which, as the gentleman from California said, were given affordable housing goals, essentially told to go out and ensure that money was lent to people who ultimately could not afford to pay it back. The whole system bought in because the government incented, cajoled, and mandated that action, and the rest is history, and I would hope that the panel would conclude likewise.
Looking back at what's happened in the past year, you say no more bailouts. Were the bailouts that did take place necessary for this economic system to get back on its feet?
Well, I think that's something that we will never know, but what we do know is that we have created a disincentive for what I would call appropriate market behavior, because we intervened into these entities not in just a small way but a big way. And as I started my remarks, I think the big issue here is how do we unwind what we started? I've said all along that if you think this this marriage has been rocky, wait till you see the divorce when we start to try to unwind the federal government from all these entities and start having entities then have to go out and assess risk and take risk and have capital go to where they think they can get the best reward on risk and get back to, what I call the normal blocking and tackling of a market system. But this intervention, I think, blocks that, and it will take, I think, many years for us to get markets back to behaving in a normal way.
What's your plan for advancing this proposal? Are you going to introduce legislation? Are you talking to Congressman Frank about it?
We've already introduced legislation, and we really have urged the Congressman Frank and the administration to take up our proposals, but we wanted to communicate once again to the American people that we do have an alternative, and we think it's a sound alternative. Talking about what precipitated this, we had gaps in the regulation, and we addressed that. That's not really been addressed. We also had, as almost every member referred to, is we have had lack of enforcement, because there were capital requirements, there were safety and sound requirements, there were obviously either with unregulated institutions, there were gaps in the regulations, or there was lack of enforcement. And I guess Madoff would be the poster child of that, is there were the laws. And I think before you start creating more laws and more agencies, you have to address enforcing the laws that we have on the books. We also, we quite frankly did have new products, new, credit default swaps, collateralized debt obligations, things of that nature, securitization, which was a good thing gone to the extreme. And I'm not sure that our regulators were up to the task or had the expertise to regulate those new products. We address that.
Mr. Royce, you're talking about 2004 being sort of the critical period when Congress sort of dropped the ball. Republicans were in charge of Congress at that point, and the regulatory agencies were headed by Republicans at that point.
Right.
Have Republicans learned lessons from this? Why should the American people at this point look to you guys?
Well, Chuck Hagel in the Senate carried the bill for the Republicans and got it out of committee and onto the floor. It was Chris Dodd who opposed it, and we're talking specifically about the bill which would have allowed the GSEs to be regulated for systemic risk. It was actually carried at the request of the Federal Reserve, and the debate really was a debate over whether or not we would allow the Fed the authority or allow the regulator the authority to do what the Fed had requested. In this case, they were looking at leverage that they quoted as 100 to 1, and they were saying that because of this over leverage, we faced a situation where it wasn't just a systemic risk to our financial system, it was a worldwide systemic risk. So in point of fact, it was the Republicans in the Senate who supported that position. It was the Democrats who opposed. Over on the House side, I carried that amendment on the House floor, but it was in the Senate that the major effort was made. The reason I bring this up now is because it was an exact example of bifurcated regulation, you see. And if we do this again, and we set up two competing agencies, especially in the face of the concerns that the safety and soundness regulators themselves have raised, then I think we risk going through the same mistake. Given the losses that we faced in housing and given what a disservice it was, especially for people who were really stretching to try to avail themselves of these new loans. You know, Congress had leveraged this down to 3% down or 0% down for these loans, which had traditionally been 20%. We were able to do that through government intervention into the economy. At the end of the day, we did no favors for those people because by and large they lost their homes. So what I'm saying here is that we're failing to learn the very real lessons that economists are pointing to as examples of misguided government intervention into the economy.
A question on the resolution trust or resolution approach. The way I understand it is that the way the White House the administration proposal has it would pay the large institutions would pay after the fact of an insolvency to fund paying off counterparties in that insolvency or part of their payment so that they wouldn't have a systemic impact. And then there's a lot of effort among administration officials, for example, Sheila Bair, that would have a deposit insurance pool that would pay in advance, and that would go to pay off these counterparties. So the administration argues that this is not more bailouts with the resolution authority. How would you, I just wanted to see if you could respond to this, that this would not be taxpayer funds, this would be funds from these large institutions that would supposedly pay for their resolution so they don't cause this collateral damage. And then I guess second, if somebody could talk a bit about the trust, the AIG trust, and if there's any support for that and why that is important.
On the resolution authority, we looked at this very carefully and felt that the best way to instill the most transparency and the most accountability was to use the system of justice that's set up through the bankruptcy courts by creating a special class of bankruptcy for these financial institutions. And if you look at the FDIC as an insurer, we just passed a piece of legislation that upped the ability for the FDIC to go to, what was it, 300? 500. 500. Well, that's the implicit, that's the federal government taxpayers stepping up to the plate again to give a backstop to this. And I'd like to Jeffrey Lacker, who's the president of the Richmond Federal Reserve, actually made some comments on this yesterday. And I'm going to read a couple quotes because he says, and it's just right on target to where our plan, I think, addresses this issue much better. He says, if not carefully crafted, establishing a procedure for the government to take over and wind down failed big financial firms without forcing it into bankruptcy could create new moral hazards that could weaken market discipline and could lead to more, not less, volatility. And he says that we would be expanding government protection and regulation if we went the way the president wants to go, and that he feels that it would be better placing greater reliance on market-based incentives for prudent risk management. And I think that's sort of the foundation of where we think a special class of bankruptcy created for these particular institutions with the expertise that would come along with that bankruptcy court would, I think, be more transparent, more accountable, and would take it out of the realm of the taxpayers and government dollars.
We'll have one more question.
Sorry, on the trust, why is that trust important? The AIG trust, why would the AIG...
You're talking about the legislation that we intend to offer?
On that specific part of it, yeah.
Well, it would be AIG, Citi, General Motors, would be covered. We think that that we ought to wind down the government ownership of these corporations, that's not what the American people want, and that's their government taking equity interest in companies and managing them. And I think the poster child there is General Motors, which I think has created problems that we'll continue to see. It's almost as if you're going to repeat the mistakes of Fannie and Freddie once again.
On derivatives, you've been hearing from end users about problems with the Obama plan. What would your proposal do and how would it?
Basically, the derivatives concept is not a part of this initial plan. We're working through that in the Ag Committee, and on financial services, we're waiting for the majority to offer something up. Unfortunately, even though we passed an initial proposal in the Ag Committee back earlier in the year, the concepts that Chairman Frank seems to be working on are slipping. Most recently, I understand, perhaps he has said that perhaps nothing needs to occur as late as December. We'll see. But from the Republican perspective, we need to be sure so as to not upend an industry that is so important to spreading out risk, to making things more affordable from a business perspective. That's the challenge. The end users are saying, oh my goodness, you mean they're going to have the ability to basically create these whatever kind of margin accounts? They're going to have the ability to set these substantial capital accounts? In effect, their fear is that we will have regulators who won't understand the industry, the business, that we'll have political pressure from the White House directing those regulators, and that they'll create a situation where it will be impossible for energy companies or ag companies or any other business to be able to use these markets to protect themselves financially in the future. It's kind of ironic that, of course, the Chief of Staff at the White House has some experience in dealing with these commodity issues.
Why would those companies then use standardized contracts?
I think I'll go ahead and answer that, and we'll wrap up with
just simply because a lot of the transactions, whether it's oil and gas or agriculture that go on, are very unique in nature. Now, we're not saying you shouldn't have more oversight. We're not saying more transparency. We absolutely agree with that. But we need to hit that fine line down the middle and not be destructive in the name of just doing something for the sake of doing something.
Thank you.